Thanks for clicking. We had a big week in China's real estate market this week, with Beijing growing increasingly frustrated with the lack of progress in the real estate sector, exerting more pressure on the banks to get lending. We also received news reminiscent of the 2008 financial crisis, with Beijing setting up an emergency backstop fund just in case of bank failure. And it might be coming just in time as we receive news of even more defaults this week, with Evergrande refusing to cooperate with the international credit ratings agencies.
You obviously don't care.
With that said, Beijing is anxiously awaiting to see if the loosening of restrictions on mortgage rates and the opening up after the COVID lockdowns will help to revive the real estate sector. So what I want to do today is look at the increased pressure coming from the People's Bank of China, the PBOC, on China's banking sector, take a look at China's new financial stability fund aimed at preventing bank failure, and then finally look at some good news finally coming out of the real estate sector. Marginally good news, but good news nonetheless. Whether or not China will be able to revive its real estate sector in the wake of the COVID lockdowns, especially with defaults continuing, remains to be seen. We will have updates out on China's real estate sector, on its economy, every Friday on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into China's banks. We spoke last week about the PBOC summoning representatives from 24 of the biggest financial institutions in China in order to encourage them to get lending, to get money into the real estate sector.
There's no money.
Thus far, however, that encouragement has been falling on deaf ears, as the banks, even though they're awash with cash, have continued to refuse to lend. While we did receive news this week that demand for loans just isn't there, the banks have also been refusing to lend money to China's real estate developers over fear of continual defaults.
They're all bums. They never pay.
Indeed, it was reported this week that they've been reluctant to provide new loans to China's real estate developers, only offering to roll over existing loans, and they only made that offer for fear that if they didn't, the loans that they already have would show up as a loss on their books. So they're rolling over debt for fear that if they didn't, these developers would default. As a result of the banks refusing to provide new loans to real estate developers, local PBOC officials are having meetings with local banking officials to demand answers from these banking officials as to why they're not propping up this falling real estate sector. While we don't yet know the results of these meetings, Bloomberg noted that PBOC officials have stopped short of punishing the banks for not lending to the real estate developers. And we received more news this week as to why the banks are even more hesitant to lend to these real estate developers. If you'll remember Shimao, a developer that was once considered strong and safe, it was reported this week that they failed to repay investors after initially agreeing to a payment plan on one of their trust products. So Shimao has failed to make its payments even after undergoing a repayment plan. And as we noted earlier, Evergrande has stopped cooperating with the international credit rating agencies.
Why all this sudden interest?
As a response, with fears that these real estate defaults could continue and could cause a major shock to the banks, China is setting up a financial stability fund in the case of major failure of one of China's major institutions, be it its banks, insurers, etc., with the aim of having $100 billion put together by September. Beijing also noted that the fund is meant to provide assistance in the case of bank failure due to market turmoil stemming from the West, stemming from monetary policy, our tightening conditions here in the US and in Canada.
I don't trust any of you.
So Beijing is well aware that they are not entering into this post-COVID lockdown recovery without continual problems. They have a real estate sector that is continuing its defaults, and they have tightening monetary policies in the West, which very well could slow demand for Chinese products as they attempt to recover from the zero-COVID strategy. While the move to create the Financial Stability Fund was no doubt an effort on Beijing's part to reassure investors that it's well prepared in the case of major failures of one of its institutions, it also does demonstrate that Beijing understands it's not out of the woods yet, with its zero-COVID lockdowns ending in short order. With that said, we did receive some good news from China's real estate market this week, as sales data for May, while still poor, is inching its way up, improving by 5.6% since April. With real estate representing 25% of China's GDP, according to Moody's, the revival of the sector, the revival of real estate sales, is going to be key to China's post-COVID recovery. The Global Times also noted that China saw an uptick in interest in second homes during its 3-day holiday sale. This is a relatively small amount of good news, but with China's banks refusing to lend, with China's borrowers not wanting the money in the first place, with continual defaults and China setting up a financial stability fund in the case of bank failure, you take the good news when you can get it. Whether or not China's banks will be able to convince these banks to start lending to the developers that are continuing their defaults remains to be seen, but we'll obviously have updates out on the banks, on China's real estate market on this channel every Friday. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.